Hi, so welcome to this webinar. We're going to talk today about how you can raise six, seven, and eight figures to acquire profitable businesses using debt. So quick introduction to me. My name's Paul Seabridge. I'm the founder of OPC Capital Partners. We've completed over 100 transactions in 32 different industries in 12 different countries. I'm the best-selling author of four books now. For those people that are attending this webinar, you will have been provided with a copy of my latest book, Buy It With Debt, which is essentially what we're going to talk about today. Over the past 15 years, I've raised around about £500 million of capital to support these types of transactions. So this is an example of a deal analysis that we're going to deep dive into today, where I can actually show you a real example of how funding, how we raise capital with a live deal. So it doesn't matter whether this is your first rodeo or whether you're a really experienced deal maker. My goal today really is to cover several things. That ultimately we're going to talk about how leverage buyouts actually work, the different types of funding that we can use to support these types of transactions, how lenders evaluate those deals, what lenders actually care about, and then how to actually make the approach to the financial institutions to get the funding to do these deals. We'll talk about debt covenants, what they are, and how to negotiate them. And if this is your first rodeo, you can build a dream team that essentially will be the key really to how do you approach a bank that you've never, with no track record, you've not done any deals before. So we'll talk about how you can use a dream team to leverage that credibility and capability. But equally, if you're a seasoned deal maker, how you can actually use that to ultimately raise more capital to do more deals. So my goal is really by the end of this webinar that you're going to have a really good understanding of how acquisitions are funded in the real world. So before we get started, let me just talk about the opportunity. So globally, I think the estimates are there's around 350 million small businesses in the world. There's about 30 million in the US, 5 million in the UK, 2.5 million in Australia. I mentioned those three countries because that's probably where we are most active. Now, most of these businesses, around about 30% of them are owned by the baby boomer generation. Most of them that are possibly coming up to that sort of retirement age don't have any succession plan. They don't have any family successor. They see that their kids see how hard it is to run a small business and don't want that sort of pressure. And the size of these companies mean that they're probably not big enough for private equity. Most private equity deals don't tend to work under the sort of 50 million revenue range. So that's sort of really where our opportunity comes. So the biggest myth in business acquisitions, do you actually need money to buy businesses? Well, let me take you back to 2003 with the first transaction I ever did. I actually thought at that particular point that I needed to have some savings that I could deploy into making acquisitions. And I didn't actually understand that, you actually can just borrow the money and that this is how deals work. If you look at the biggest leverage buyout transaction in the past few years in the UK, for example, Walmart, one of the biggest supermarket businesses in the world, sold Asda, which is one of the largest supermarkets in the UK, in a $10 billion deal. The vast majority of the funds to support that acquisition were borrowed money. So, whether it's a small business or one of the largest transactions, this is typically how M&A works. So, yeah, essentially businesses are acquired using structured capital. It could be bank debt, it could be asset-based lending, it could be invoice finance, it could be seller financing, it could be earnouts. But most of the time, and certainly what we're going to talk about today, these businesses are acquired using the funds of the business or its assets to fund the transaction. So this is not a topic for today, but yeah, what's a leverage buyout? So essentially, a leverage buyout is you acquiring a business using borrowed money where the cash flow of that business is used to repay that debt. For anybody that's interested, I have wrote a book on the process of how you, what leverage buyout's all about, how you find deals, how you structure them, how you put them together, the process we follow, start to finish, from finding that deal to actually getting it over the line. For anybody that's interested, you can get a copy from Amazon. But really what lenders are focused on is cash flow, assets, risk mitigation, and the serviceability. They're not primarily interested at all in your personal wealth. And I do offer free deal maker training. Anybody that's interested, you can go to my website, paulseabridge.online, and in the top, you'll be able to see free deal maker training. You can put your details in there, and we run regularly a free seminar where we basically cover the process start to finish on how leverage buyouts work. So we're not going to dive into any of that today in terms of the process that we follow. But yeah, essentially what we're going to be talking about is how we fund these leveraged buyouts. So why does this work at SME level? Well, private equity firms use leverage to amplify returns, and the same principle really works in small businesses. Ultimately, what you need is a fundable business, a sensible purchase price, a structured capital stack, and a credible team. You certainly don't need, personal wealth to be able to transact. And I guess most people that don't do deals is because they have common beliefs that they don't have the capital, they've never bought a company before, they don't believe that banks would lend to them or take them seriously. But ultimately, what lenders are looking for and what they underwrite is cash flow, assets, and risk management, not your bank balance. So we're going to dive into a little bit of detail around how you position yourself, how you can approach lenders, how you can structure deals with those three things, those fundamental things, really at the forefront of the mind. So debt is not one product. Debt is a toolkit of different instruments. So a single acquisition typically will use multiple layers of finance. It's not just one bank loan to fund the transaction. So, in a typical leveraged buyout sort of, capital structure, you might see invoice finance, you might see some sort of asset finance. If there's real estate involved in the transaction, then you might see finance, commercial property finance. We talk about term debt, which tends to be complementing those asset-backed forms of lending. And we'll also talk about seller financing. So before we sort of dive into the specifics of, what each of those different types of funding looks like in terms of costs and how it works and how it sort of is brought into the deal structure, let me just be really clear. Do you need to put any of your own equity into a transaction? No. So far this year, I've raised probably around about £50 million worth of debt to support transactions. The largest debt facility that I've ever arranged is 30 million, and that was arranged completely asset backed, none of my own equity going into the transaction, with no personal guarantee whatsoever. So, of course, when you go and talk to banks, it might seem a little bit alien to them that, well, where's your skin in the game? Why aren't you putting any of your own money in? Will you sign a PG? We'll talk about how to approach those sort of typical objections as we go through the presentation today. But yeah, essentially, you don't need to put your own equity in, and you certainly would certainly recommend not signing a personal guarantee. Whenever you do these transactions, we always recommend using a newly incorporated SPV, so special purpose vehicle. It's a limited liability company that becomes the buyer of the target business that you want to acquire, and it is the buyer that is ultimately borrowing the money against the using the collateral, the assets of the target business that you want to buy. If you sign a PG, then essentially you're just piercing that corporate veil, and you're holding yourself then to become personally liable. So we don't recommend that. If you do have equity or access to equity through friends, family, other investors, clearly if you're going to put equity into a transaction, then it does make the funding options flexible and cheaper. So, if this is your first rodeo, you might want to do one or two of these no money down type transactions where you borrow all of the money to put the deal together. But once you've actually got some cash flowing assets, well, potentially you could use some of that cash flow to fund deal number 3 or 4. And essentially you're putting your own equity into the transaction, which is always going to be mean that you'll get more flexible and probably cheaper solutions, but it's certainly not essential. Um, so a typical structure will be, you'll have your overall valuation. Typically for these sorts of transactions to work, you're probably paying a multiple of profits or free cash flow, probably somewhere in the region of 2 to 3 times multiple. So if you've got a business that's making £1 million a year, you might be paying 2 to 3 million for the goodwill. And then you will fund the initial payment with debt, and we'll dive into those debt instruments in a moment. And then there might be some sort of seller financing or earn-out structure. And if you're putting your own equity in, then that would obviously be factored in as well. So once you understand this toolkit, it really does change everything. So like I said, let's have a look at the specifics. So invoice finance. So in a if you've got 100 customers and you send out 100 invoices for 1,000 sorry, 10,000 pound each, you've then got £1 million owed to your business. That's your receivables. You can borrow against those receivables in invoice finance. So contrary to belief, this does work really well in B2B service industries. If anything, for me, this is probably one of the easier forms of funding that can be arranged. And typically you can advance between 70 and 85%. So if you've got a business that's owed 2 million by its customers, so 2 million in receivables, at 75% advance rate means that you could borrow up 1.5 million against that asset. So receivables then become the acquisition funding. So yeah, it works really well in B2B service industries, but it also works well in manufacturing, engineering, and construction. Just a thing to note, what invoice finance providers like is really clean, easy to understand, easy invoicing, easy customer journey. What they don't like is what we call contractual debt. So this is quite common in, say, construction businesses, where if there's deposits, milestone payments, certain deliverables that have got to be achieved before that ultimately will unlock payment of those invoices. That puts the invoice finance company at risk, because essentially those invoices could be open to dispute at some point. Whereas if you are a widget manufacturer and you just make the product, ship it to the customer with an invoice, and the customer pays you 30 or 60 days later, that's not contractual. That's really simple. So invoice financiers do like that. So if you do have an acquisition where it is contractual debt, like the construction example that I've given, then that is possible. You can certainly fund against that. There are lenders in all of the marketplaces that we operate that specialise particularly in construction-based businesses, but your advance rate is going to be a lot less. You're probably looking at maximum 50%, if not lower than that. And then typical costs for invoice finance is that you're not paying back the capital, so you're just paying interest on the funds that you borrow. That could be 8 to 10% as a sort of typical rate. So if your receivables are 2 million, you're not paying 10% of that in interest. You would be paying 10% equivalent over a year. So 10% divided by 365 days of the year, multiplied by however many days it takes you to get paid. You would only pay interest on the funds that you would advance until those funds are then ultimately paid by the client. So if you borrow against an invoice, but your client pays you in 30 days' time, you're only going to pay interest for those 30 days until that invoice is settled by the customer. There'll be a service fee, which typically might be between 0.35 and 1% of your revenue. So every invoice you put through the facility, you'll pay a service fee. Most invoice financiers will expect some sort of credit insurance. So in the event that your customer goes bust, they're going to want some insurance to insure against that eventuality. That typically could be a fixed price, or it could be as a percentage of your invoice, maybe between 0.3 and 0.5% of the invoice value. Most lenders will charge some sort of arrangement or setup fee. So, we'll have a look at a specific example actually as we go through the presentation today to actually look at, what a real facility, actually costs in terms of adding up all of those things. Asset finance is another debt instrument that you can use. So, quite common in manufacturing and engineering businesses. They often have machinery, equipment, vehicles, and these can all be funded through hire purchase, asset finance, or sale and leaseback type arrangements. And typically, they'll advance between 50 and 70% of the liquidation value of those assets. So, just because a business may have in its accounts £1 million worth of machinery, that doesn't necessarily mean that that's actually what the lender would value it at. They often look at the liquidation value, which is essentially if they had to sell all these assets tomorrow in a fire sale at an auction, it's going to achieve far less than if you market it for sale over a 3 or 6 month period. So typically, you're looking at sort of 90% of the liquidation value, which if you take the sort of pre-depreciation value is somewhere between sort of 50 and 70%, and you're typically looking at somewhere between 7 and 9% interest. So if you borrowed £1 million against machinery over 5 years, you'd be paying 200k capital back every year, and at 10% interest, you'd be paying 100 grand in interest. So that's sort of how that would typically work. You can also do like a sale and lease back, but the sort of rates that you'd be paying tend to be similar. Property finance, so essentially you're borrowing funds against the premises of the company. Typically, you can borrow between 50 and 70%. In some more limited cases, maybe up to 75% of the value of the property. So on a 2 million factory, at 70% could release 1.4 million in funding. Your typical costs will be somewhere between maybe 6.5% and 8% currently. And there are options to just do interest only financing rather than having to pay back capital. Usually that tends to be for maybe the first 2 or 3 years you only pay interest and then you start paying back the capital. And it tends to be amortized. Depends on the country. The UK is probably 15 to 20 years. In the US and Australia, it can be spread over a longer period of time. So, if you were a business owner already owning a company that owns its real estate, then you can potentially amortize over a lot longer period. But from a leveraged buyout perspective, lenders typically, the appetite from them is really around about 15 years at the moment. Term debt, also known as cash flow lending. So these are just essentially term loans based on the EBITDA, so earnings before interest, tax, depreciation, amortization. And typically you can leverage multiples of maybe somewhere between 2 and 3.5 times EBITDA. So, a company that's making $1 million in EBITDA, 2.5 times that could potentially give you a 2.5 million loan. But yeah, really the key metric that lenders will focus on is the debt service coverage. Term debt pretty much is not possible unless you're putting your own equity in, or it's got to sort of sit as a sort of secondary type of funding in conjunction with asset lending. So normally, if you're not putting any of your own money in, you would maybe look at doing invoice finance or plant and machinery or maybe real estate funding, and maybe they'll top up the deal with some sort of term debt. And typically that term debt would be amortized over the same period as you're paying any seller financing. So if you do a deal to acquire a company where you're going to pay the seller financing over, say, a 4-year period, then the term debt will mirror that period. You won't be able to stretch that term debt for longer. And typically you're going to be looking at around about 8% as a sort of cost. Just before we get into this next slide, something I've not mentioned is if anybody's got any questions that they want to ask, please use the chat box, and I'll pick up the questions as we go through the presentation, and certainly at the end I'll address any questions that people may have. So debt service coverage ratio, this is probably the most important metric in acquisition finance. To work this out, you take EBITDA and you divide it by the annual debt payments. So if the business is making $1 million in EBITDA and it's going to cost you to service the debt from the acquisition 600k, so that's your capital repayments, your seller financing, the interest, the service fees, etc., on your whatever you're borrowing to do the deal, then the DSCR in that case would be 1.67. So 1 million divided by 600k equals 1.67. Most lenders require 1.2 to 1.5 as a minimum. So anything over and above 1.5 is great. Anything under 1.2, you're going to be very much challenged to get that deal over the line, because ultimately what lenders want to do is make sure that there's ultimately enough cash flow to service whatever borrowing you're going to take on. We're not going to cover these in today's webinar, but I'll just mention them anyway. There are other types of funding available. I could probably stand here all day and talk about funding, but we've only got an hour, so we're not going to get into the detail of other types of funding. But you could, if a business is manufacturing something and it holds inventory, then you can raise finance against that. That tends to work better for big ticket items. So if you're an automotive company selling vehicles, big ticket items, you can probably get stock finance against those. But if you're selling plastic widgets for $1, you're probably not going to be able to get stocking finance. And that tends to be more not necessarily used in the capital stack for actually doing the acquisition, but more to support working capital post-transaction. Trade finance essentially allows you to pay your suppliers it almost sort of works opposite to how invoice finance works, but for your suppliers. Again, not for making acquisitions, but could be used to support working capital post completion. Larger loans and revolving facilities. Typically, if you're, putting equity into a transaction, then you can look at, more creative senior debt type solutions. And of course, equity investors as well is another route for funding. You'd be putting equity in, not taking on debt, and we're not talking about equity today, but that's obviously another source for being able to do transactions. People that work with us to do acquisitions, we run OPC Capital Partners, so essentially we work on a joint venture or advisory capacity to our clients, so we can help them through the process of how to find and do deals, and also support them with arranging the funding. But also anybody working with us will have access to we currently have around about 880 high net worth private investors that we've built relationships with over the past 15 years that we can tap into for equity funding to make transactions maybe more workable. So let's build the capital stack. Let's look at a sort of example. So let's say we've got a company where we want to purchase it for 6.2 million. The high level figures are that it does 7.7 million of revenue. It has EBITDA of 1.5 million and EBIT of 1.2. Let's say we're going to agree a deal to buy this for 6.2. We might raise 2 million out of invoice finance, 2.2 out of asset finance, 400k out of real estate, and the balance, the 1.8, would be seller financing payable over a 5-year period. So the total funding, as you can see there, comes to 6.8, and that's obviously more than the 6.2. But what we've got to then factor in is, any fees or possible working capital adjustments that we might need. So we're borrowing, actually, in this example, a bit more than we need to purchase it. Approximate debt servicing on this particular capital stack: invoice finance would cost you around 220k. Asset finance would be 638k, which is amortized over 5 years at 8%. Real estate would be 48k over 20 years at 8%, and the seller note would be 366 a year over those 5 years. And in this example, we're not putting any interest on that seller note. You can, of course, negotiate interest on seller financing. Most sellers I actually find don't ask for it, so I would never offer something unless I'm asked. But in this example, we're not having any, but that could be part of a capital stack. So the total is 1.275 million to service all of that debt, paying the invoice finance fees, the asset finance, the real estate, the seller note every year, which gives us a debt service coverage ratio of 1.2. So that's quite tight in this particular example. I think ideally you'd want that to be 1.3 to 1.5, but it would certainly be workable as long as you stress test, and we'll talk about how you can deal with lenders and the sort of objections that they may have to something like this. If I take an average for the past 4 years at OPC Capital Partners and all the deals that we've been involved in, typically we're paying a multiple of EBITDA of 2.52 times, and we're paying a deferred off over a 3.5-year period. That's the average across multiple deals. And the only way that you could maybe make this particular capital stack more attractive would be to either increase the deferred term, so your exposure to the seller every year, you're going to pay them less over a longer period of time, or introducing equity into the transaction to reduce the amount of borrowing that you might need to do from a financial institution. So let's have a look at a real deal analysis. So You don't have to be an accountant when you're doing this sort of stuff. I'm not an accountant, but I believe that I have a reasonable financial acumen. I can interpret a P&L, a balance sheet. I can understand the sort of numbers. If you're not an accountant and you don't have that financial acumen, my advice would be to go and increase your knowledge on all of this before you even think about doing deals, or bring somebody onto your team. Maybe you pay them in equity, that perhaps is an accountant that can help with all of the sort of financial side of things, or partner with somebody like ourselves where we have those people on our team that can support and help. So yeah, this is sort of a typical analysis of a deal. So firstly, we've got here just some historic P&L numbers. So generally what we tend to ask for from sellers when we're looking at deals is we give them a shopping list of information, which will include 3 years statutory accounts and recent management accounts. And then all we're doing is we're extracting this information into a spreadsheet. So you can see here 2023 business did 8.3 million and revenues declined a little bit to 2025 at 7.7. Its gross profit margins have also tightened a little bit. 3 years ago it was doing 53%. It's now dropped to 48%, and its operating profit is almost halved in that period. So in 2023 it was 2.3 and it's dropped down to 1.25. We then add in the interest, the depreciation, and then that gives us an adjusted EBIT figure and an adjusted EBITDA figure. So one of the things I'd want to understand in this particular deal is what's actually driven the margins tightening, what's driven the profitability to reduce, and is that going to be a continued trend, or are things going to get better? So yeah, we've just extracted that information, and then if there were any add backs, so any costs that wouldn't be there post-transaction. So, for example, maybe they have family members on the payroll that won't exist post-completion, or maybe they're putting big contributions into their pension, which again, under new ownership wouldn't exist. You can put realistic add backs back to that, but it's very easy to make a set of accounts look better or worse. So, I would almost run a mile where you've got lots and lots of add backs. I mean, I looked at one the other day where the statutory account showed a 200k operating profit, but when you added all of the things back that they wanted to, they were saying that the business made 1.5 million. So essentially 1.3 million of add backs just for me will be a red flag, which most lenders would pick up on. How you then value the business, so we will generally look at EBIT or EBITDA. We'll either take a 3-year average or we'll just use the most recent set of financials. We'll look at whether we do it on a cash-free, debt-free basis, or whether we're going to include cash. In certain jurisdictions, it's not uncommon for a business owner to have built up, big cash reserves over many years. They've not taken that out as a dividend, because if they did, they'd be clobbered for tax. So sometimes if they've got large cash balances, depending on which country you're doing the transaction in, you might actually include the cash and payout as part of the transaction, because it's more tax efficient for them to take it that way, because they only pay capital gains tax. So I'm not going to get into loads of detail on that because it's quite a complicated topic, but yeah, just for purposes of explanation. So what we're going to do here is, for this particular deal, we're just going to take the latest EBIT, so 1.26 million. We're going to put a two times multiple on that, which values the goodwill at 2.5. We've then got adjusted net assets of 3.7, and I'll show you that in a moment on the next slide, which gives us a total purchase price of 6.2 million. We're going to pay 4.4 at closing. We're going to pay 1.8 on a deferred seller note over 5 years, which, when you add all of that together, the 6.2 divided by the 1.2 gives you the equivalent multiple of 4.93 times when you factor in the balance sheet. Balance sheet, again, we'll just normalize it. So we'll look at what the net assets of the business are. We can then make adjustments for intangibles, for example. They might be valuable to the business, but from a funding perspective, we would typically discount them. We would also look to adjust working capital, and if there's any intercompany positions or directors' loan accounts that need to be factored in, then we'd obviously make adjustments. So in this case, there's a couple of intercompany loans, and there's also a deferred tax liability that essentially could be crystallized in the change of ownership. So we're actually reducing the net asset, the normalized net assets to 3.7. We'll then have a look at working capital. So we'll look at current assets, current liabilities, creditors. So you can see in this example that it takes them on average 121 days to get paid by their customers. They're paying their suppliers in 101 days. They're churning their stock every 35 days. And then if we were buying this on a cash-free, debt-free basis, we can adjust for working capital so we can remove the cash. So the adjusted working capital for this particular example is 867k. And we factor that into the deal. So you can see there that that's those adjusted net assets of 3.7, 2 times the EBIT, 2.5. Added those two things together gives you the 6.2. How we've come up with the upfront is basically us then looking at how we're going to fund this transaction. So in this particular example, we've got aged receivables of 2.5 million. We're going to borrow 80% of that, which gives us just over 2 million. Oops, sorry, go back. They do have some existing finance secured against that ledger at the moment, so we would have to not take that over, but actually refinance it. What you'll find in any existing debt facilities that a business may have is they probably will have change of control clauses, and if they've got like an overdraft with a bank or they're using invoice finance with another provider, then the chances are that there'll be an event of default if there is a change of ownership. So what we typically do is we look at what we can borrow, what's affordable, what we would need to pay off existing facilities that need to be refinanced, which then gives us that net figure. They own real estate, 540k, so we're going to borrow 70% of that, which gives us 378. Plant and machinery, this is an industrial business, so we're going to borrow 75% of that, gives us a 2.2. There's a little bit of other term debt that we would need to refinance out. So we've estimated that fees, so this could be lender fees, arrangement fees, broker fees, introducer fees, lawyer fees, accountants fees, all of those things for this particular transaction amount to about 200k. Got to pay off 100 grand's worth of existing finance, which means that we've got available to give to the seller 4.4 million, which is where that upfront figure came from. We then can work out the cost of this finance. So invoice finance would cost us 221k. The real estate would cost us 48k, so 30k in interest, 18k in capital every year. Plant and machinery, 182k in interest, 455 in capital. That's paid over 5 years. There's no term debt in this example. And then we've got 1.8 million of seller financing, which we're going to pay over 5 years, which is 366k a year. So when you add up all of those costs, including the deferred, we get total debt servicing of 1.275 million against EBITDA of 1.52, which gives us that DSR of 1.2. So this is quite a tight example. To make that better, you could extend the deferred period, you could introduce equity, or you could reduce the amount you're borrowing against each asset class. So how do we approach the lenders? And most people do tend to get this wrong. So most buyers tend to approach lenders after they've agreed a deal. And this is very much a backwards approach. Most professional acquirers build the relationship producing. If you're looking at doing an acquisition in a particular industry, before I even go and do any sourcing, find the deal, talk to the sellers, I will go and look at, is a leveraged buyout in this sector possible? Is it viable? Are there lenders out there that would support this type of transaction? So I would go and start talking to banks before I even do any of that sort of outreach or looking for my deal. So I could find that out by looking in the trade press, Google, networking, LinkedIn, look at what other deals have been funded. Most banks will put out press releases of deals that they've funded, or there might be corporate advisors that put press releases out about, deals that they've advised on. You could pick up the phone, you could connect with them, you could ask them, who funded that transaction. So that you can start to build that intel. And what I would then do is I would go and approach those lenders, and I would probably start with asking, obviously after an introduction, I'd probably start by asking them, are they in lending mode? What's their criteria? What sectors are they interested in? What are their sort of deal size? What's their leverage tolerance? What sort of concentration limits is a sort of red flag? I actually wrote a book on this called buy it with debt, which I think you've all had a copy of, but essentially we cover in detail in the book how you actually approach those conversations. So what I would do is basically find several lenders that have got an appetite, understand what their criteria and sort of leverage tolerances are, and then I will go and source deals that match that. So firstly, I go and find the right deal, and then before I make any sort of financial proposal to a seller, I'm making sure that I factored in what that lender's criteria is. So I'm not presenting a deal that's ultimately not going to be meeting of their criteria. So ultimately, what lenders are looking for is, typically credit committees will evaluate the cash flow and the serviceability. They'll want to look at the structural protection, and they'll want to look at the capability of the people that are behind the transaction. Ultimately, their question is really simple: are we going to get our money back? What lenders fear most is really uncertainty. So when you're presenting your deal to financial institutions, what you want to do really is, you've obviously gone out and had that conversation with lenders, you've understood their criteria, you've told them that you see an opportunity to maybe roll up in this particular industry, potential partners with that might, funding partners that might support this transaction. Once you've actually then got your deal, what you want to do is you want to present it in the right way. So firstly, you would build a data room of all of the sort of typical information that a lender may want to see. So that will be financial information, aged receivables, asset valuation reports, all of those sorts of things. I'll talk about the shopping list of sort of key information at the end of this presentation, but you'd also then want to do your sources and uses. So going back to that capital stack before, we were going to borrow 2 million in plant and machinery, we were going to borrow 400 in real estate. So you sort of do all of your sources and then what you're going to use the funds for. So paying out the seller, professional fees, working capital, and essentially the sources and uses will equal the same, they'll balance. You then want to have your deal structure or term sheet very specifically spelt out. You want a business plan, and we'll talk about business plan in a few slides time. You want a very detailed financial model, and again, I'm going to show you an example of what that looks like in a moment. And then what I would then do is probably produce an initial teaser, which is an anonymized version of the opportunity. It's a one-pager. It sort of sets out the deal, who's involved, the high-level financials, the high-level deal structure, and maybe high-level sort of sources and uses. What you would then do is get the lender to sign an NDA before you then either release your business plan and all of that other stuff, or you'd produce a more detailed memorandum that sort of summarizes all of that sort of stuff. And then if you have not got any experience of doing deals, my recommendation would be to take along people that have done deals before. So we'll talk about the dream team a little bit later on in the presentation, but if you've got a 30 or 40 year experienced chair in your industry, and you've got a semi-retired Big Four trained accountant, CFO, I would probably take those people with you, because that again helps with convincing lenders that this is a deal that they can do. So the approach is really to overcome any potential uncertainty that a lender may have. So, that's uncertainty around cash flow. So as long as you can produce the financial data to show that your deal is affordable, viable, banks are going to get things paid back, and you've stress tested different scenarios. What happens if you lost a key customer? What happens if costs go up? What happens if there's some sort of oblivion event? The lenders want you to come to them and show that you've considered all things. It's not just about putting numbers on a spreadsheet and making it look good on paper. It's actually showing them your level of expertise in terms of you've stress tested different scenarios. So even if this happened, this is still affordable, this is still viable. Management competence, again, if this is your first rodeo and you've not done deals before, my recommendation would be to build the dream team. We'll talk about that as we go through the presentation. But essentially, if you can demonstrate you've got really experienced people behind this transaction, not just the existing management within the business, but people that you're going to bring onto the team, then again, that removes that sort of uncertainty. And obviously the information accuracy, the data that you should be producing should be, of course, accurate. So all of that preparation removes that uncertainty. So I'm just going to come out of these slides and show you an example model. So I'm not going to get into detail of this because it's a very complicated financial model, but just to give you an idea of the sort of what we actually produce for lenders. So essentially, you've got cash flow, You've got P&L and you've got balance sheet. There's a few other tabs that basically build the data for this. But essentially what this model does is it gives a month by month cash flow forecast, month by month P&L, month by month balance sheet analysis, and then that then puts it into summary. So, we've got the historics, and then we've got the forward looking position with EBITDA, the borrowings. It works out the sort of leverage coverage. So a very, very detailed model. Probably takes a financial analyst 3 or 4 days to put something like this together in detail. But this is the sort of level of detail that you would want to be able to present to a lender. And then you would show different versions of this. So, what if costs rose? What if you won a key contract? What if you lost a key customer? You probably want to show 3 or 4 different scenarios, so that when you're talking to a lender, you're almost preempting, have they, instead of the lender saying, have you thought about this? Have you thought about that? What happens if this happens? You can show them in your financial model that even if those things happen, we've already considered that, and we believe that this is, affordable and viable. So let's go back into slides. In a business plan, I'm not going to show you an example of this, but essentially this isn't necessarily a business plan that you would use to run the business. This is a business plan that you're going to present to the lender. So it will have core sections. So it'll have an executive summary explaining the opportunity, how much you're looking to raise, what you're looking to do, the business, the background, the historic financials, really selling the opportunity. You've then got a section on the deal structure, both the legal, so maybe using a new SPV, who's owning, what the ownership structure of that looks like, and then the financial sides of the deal. So, initial consideration, seller financing, earnouts. You'll have the very detailed modeling that you can share. You probably just have a very simple table showing, revenue, gross profit, net profit, EBITDA, and then you can, just put that in very simple format. Sources and uses, again, what you're looking to borrow, what that's going to be used for. High level plan on sales, marketing, people and operations, people being quite an important section. So again, when we talk about the dream team, if you've got some really experienced people that you're working with to do this transaction, then you want to highlight their skills, experience, track record. And then at the end, you've got a summary and contact information. So the dream team, lenders fund teams, not individuals. So I think for me, when I first did my first ever transactions, prior to getting into M&A, I'd spent 7 years building a business in the HR and recruitment industry. So every day I would preach to clients, your business is only as good as your people, so hire better people. Richard Branson once said, it's okay to be the dumbest person in the room, surround yourself with people that are smarter than you. So this is very much the concept here. So you can drastically improve your chances of being able to get funding if you basically position yourself as a deal maker and a facilitator. So your job is to bring the deal, connect it with the capital, and have the team that can execute. So your job is a facilitator to bring those 3 things together. So on the dream team, you would have probably an industry chair, somebody that's got 30 to 40 years experience in the sector. Probably have a financial expert. So this is a Big Four trained accountant. Maybe they've worked at CFO level. Maybe they're semi-retired partner from an accounting firm. But essentially what you've got here is somebody that's got vast industry experience and somebody that's got vast financial expertise. And both of those should have experience of M&A as well as obviously their respective specialisms. And what these roles do is they reduce that perceived risk. It adds a significant amount of credibility to the transaction, and it also helps defend that financial model. So how do you find these people? Again, in my book, Leverage Buyouts, we talk about how you can build the dream team, but you look on something like LinkedIn, you network, you ask people, and then how do you get them to join you? These people have spent many years building their reputation, so they've got to obviously buy into you and the plan. But if they buy into you and your role as a facilitator, you can pay them in equity. So maybe you give them 5 or 10% of any deal. But we're not going to talk about the specific how you actually go out and find them and recruit. That's a whole subject in itself. But essentially, the principle here is to improve your chances. And even if you're a really experienced deal maker and you've done lots and lots of deals, when we go into a new industry, even though we've done over 100 transactions, I'd never even dream of doing that without having some sort of industry expert. Not just from a maybe trying to get the funding side of things, but just having that expertise on the team is going to help foresee issues and deal with problems that may arise. Debt covenants. So covenants are essentially conditions that are attached to the loan. So common examples might be maintaining a minimum debt service coverage ratio, a maximum leverage figure, maintaining a tangible net worth of the balance sheet to avoid any leakage of big dividends or funds coming out of the company until the lender is repaid. Customer concentration limits. So if there's exposures to maybe you've got three main customers, that would be quite high risk. So maybe they might limit that in invoice finance, maybe restrictions around dividends. So essentially covenants are there to act as early warning systems for lenders. And I think the biggest mistake that most buyers make is they just look at basically leveraging the crap out of a business, maximizing as much as they can possibly get to give to the seller. And this is where I've seen structures fail, because those aggressive structures will always fail when performance dips. And whenever there's a change of ownership, there's always a key risk that, all of the relationships with staff and customers are tied up in that owner. Staff may leave, customers may decide to go somewhere else because the owner's no longer involved in the business, or maybe people in the supply chain are getting a bit jittery because they're not dealing with the same seller that they've dealt with for many years. So there's always that risk that goodwill can evaporate post transaction. So it's really important that we consider all of that in our financial modelling. So never leverage the hell out of a business. Do something that's affordable and viable, even in the scenarios where performance could potentially drop. And really, professional acquirers do structure deals with having that headroom, using conservative forecasts, and having those sort of covenant buffers, if you like, built into the model. So yeah, goal is about showing survivability, not being really aggressive. The real acquisition process then is, starts with identifying that opportunity. What industry can you roll up in? Going to talk to the lenders before you even go and do any outreach. Once you've got your sort of, two or three lenders with the right appetite and understanding their criteria, you then go out and do the whole sourcing, putting the deals together, having the conversations, negotiating, structuring, and ultimately getting to a point of agreeing the heads of terms with a seller. You would then prepare the lender teaser once you've got your data room and you've interpreted that data and you've built your modelling. And you then go out and have those conversations with financial institutions to secure that indicative funding. You then run your due diligence exercise, really in parallel to all of that, that they'll do their due diligence on you and the business and the opportunity, and then ultimately you get to a sort of credit approval process, and then we can move towards a completion after the legal process is done. Typically, once you're ready to do your outreach, it takes maybe somewhere between 2 to 3 months to actually getting to a point of agreeing a deal. You spend 4 to 6 weeks finding the deal, 4 to 6 weeks to negotiate it and agree the heads of terms. You then probably spend a month of due diligence and building your capital stack and putting the sort of funding together. You then probably spend a month with the lender on the actual process itself and going through their credit approval process. All while that's happening, you've got the legal process happening concurrently, and then you get towards a completion. There are people I've worked with where they've been able to sort of pull off a completed deal within 4 months of working with us, to others that have maybe taken 18 months to 2 years. It's not something that typically happens overnight, but it is a structured, repeatable process. So the key principle really is businesses aren't bought with savings; they're bought with structured capital, where risk has been managed with credible people behind the deal, experienced people that know what they're doing, and with disciplined deal structuring. And I think once you understand this framework, acquisitions just then become very much repeatable. So before we dive into questions that people may have, just some final thoughts. We are living through the largest transition of business ownership in history. There are millions of profitable SMEs that will change hands in the next decade. And the simple question is, will you understand how acquisition finance works when the opportunity appears? So hopefully you found, from a high level point of view, that this presentation useful for today. If you need a professional to help you with this, all of that might sound really daunting, and if you're not an accountant or an experienced deal maker, you might want to look at creating a joint venture with people like us, or you might want to work with experts that are used to following this process day in, day out. So we recommend finance4.business. They are basically all market advisory firm that basically will do all of this work and put all of this together and help you arrange funding for your transactions. Their core markets are the United States, Canada, the United Kingdom, and Australia and New Zealand. They do look at other markets as well, but I guess they're the sort of core markets that we look at. So, they don't just have the relationships with lenders in those locations. They also understand the business landscape, the macroeconomic climate, and the sort of tax and legal nuances between those markets. And for anybody that's interested in actually learning more about how to do acquisitions outside of the funding side that we've talked about today, you go to my website, paulseabridge.online. At the top, there's a button that says free dealmaker training, and we run regularly free seminars. Usually they last about 4 or 5 hours, where we cover in detail the whole sort of leverage buyout process of how you find and do and structure deals. So for anybody that's interested, you can reach out to both of those. Before we just dive into Q&A, this is a sort of shopping list of information that, if you go to Finance for Business, this is the sort of information they're going to ask from you for your particular deal. So, for all types of funding, they're going to want to see 3 years statutory accounts, recent management accounts, including balance sheet, your sources and uses, your deal structure or a copy of the term sheet. And then depending on the type of financing you're wanting to arrange, if it's invoice finance, they're going to want to see the age receivables, and they're going to want to see the customer journey. So that's anything from terms and conditions with customers, copy invoice, copy purchase order example. For plant and machinery, they're probably going to want to see the fixed asset register. And if there is any valuation report support the value of those plant and machinery, then that was always helpful, although not essential. Same with real estate. They're going to want to see a valuation report, and then maybe later on, after they've assessed that initial information, they might then look at obviously you'll need to provide the business plan and a more detailed financial model, but for them to give you advice as to what's the art of possible, what could a deal look like, that's the core sort of information that they would want to have a look at. So let's have a look at some of the questions. So question from Dave: how do you identify deals where you can borrow the full purchase amount? Do you need to look into tons of deals and then do this analysis, or can you figure out ahead of time which businesses will qualify for an LBO and only pursue those? Quite a few different questions there. So I'd probably recommend, if you haven't done our free dealmaker training, that maybe you do, because it probably answer a lot of that for you. But from a very high level point of view, we would generally focus on a particular sector. There are public data sources out there where you can go and approach companies. So, for example, in the UK, there's software called Endole, so it's endole.co.uk. It's their Explorer product. It's free for the first 100 searches, and then you have to pay for it. It's like 50 quid a month, I think. And you can basically put in your criteria, so you can narrow it down to companies with owners aged over 55, with net assets above a certain level, current assets above a certain level, been established for more than 10 years. So you can really filter in companies that are long established, historically profitable, consistently profitable, that have the right assets to support some sort of transaction. Probably never offer the full purchase price up front, because that's just not how deals work. Probably 95 to 97% of transactions will always include some sort of degree of deferment or earnout structure. If anything, I'd probably run a mile from any business where I could buy it using 100% of the purchase price, because you've then got no leverage. What happens post transaction if the seller doesn't have some sort of handover period where they've got to work with you to protect that goodwill, and if they've got to work for you to get that earnout or that deferred, it just helps hedge the risk. Yes, you have to look at a lot of deals. This is a numbers game. Probably for every 6 to 8 financial proposals that you'll make, you'll only get one of them that will say yes. So you've just got to be prepared for a lot of rejection. But it is a numbers game. It is a repeatable process. It's a structured, long process, but if followed, it works. So yeah, you're really trying to, before you do your outreach, you're basically setting yourself up to only approach companies that meet your criteria, that are going to have the financials behind them to do that. Yeah, that's sort of how it works. So hopefully that answers your question, Dave. Question from Ali: when do you pay lawyers' fees, before or after the transaction, and are they normally happy to get paid at the end of close? Yeah, so most professional advisors typically tend to work on a charge as you go basis, so they'll charge you an hourly rate, and that means that they're then incentivized to drag the transaction out, because the more time and effort they spend on the process, the more they can charge you, and it doesn't matter to them whether the deal happens or not. You're paying for their advice, so the deal falls through for whatever reason, you still have to pay them. That's how most professional advisors work. If you're working with us on a sort of joint venture basis, we only work with professional advisors on a contingent fixed fee basis. So A, they only get paid if the deal happens, and B, they get paid a fixed amount. So it doesn't matter whether they spend many hours on the process or hardly any, they get paid. Why do they do that? Well, because they're working with a serial acquirer that's going to bring them hopefully lots of business, lots of transactions for them to get involved in, and that's why they might be prepared to do that. So when we're looking at analysing a deal, we're factoring in what we might pay these sorts of people, depending on what country you're in. In the UK, you'd be looking at maybe 25 grand lawyer's fee. In the US, probably 40 to 50k dollars. In Australia, probably 40 to 50,000 Australian dollars. They're the sort of typical professional fees. We tend to do all of the financial work in-house and due diligence, but if you use external accountants and that, then you might be looking at 5 to 10 grand. You've got, if you're going to pay an accountant to put a detailed financial model together, then maybe you're looking at 2.5 to 5 grand. Most of those people won't do that on a contingent basis. But if you're working with somebody like us, then yeah, we factor that into the deal, and we only pay them if the deal happens. And then hopefully we build then long-term relationships with those people so that we can do deal after deal. Who do you ask for to speak at the bank, and who will understand what you're trying to achieve? Yeah, so it depends on the size of the deal and what you're trying to do, but the recommendation is don't go and approach tier one banks. Tier one banks won't fund these types of transactions unless you're putting significant equity in. So, if you're in the UK, forget about HSBC or Barclays. If you're in the US, forget about JP Morgan or Bank of America. If you're in Australia, forget about Westpac and Commonwealth Bank. Then they will not fund these MBI type transactions because they deem them as too high risk. Their lending is reserved for established management teams that have got a track record of running that particular business. So you're really approaching tier 2, tier 3 lenders, so mainly asset-backed lenders, and you're looking for probably business development managers, relationship managers, anybody that's involved in their sort of credit committee decision-making process. So let me just scroll through these questions. Sorry, Ali, what sectors does LBO work best in? And also, does it work best in any B2B businesses? So, LBOs work across pretty much any industry. There's probably a few nuances. You're really looking for businesses that aren't too capital intensive, because essentially you're using the cash flow to fund the transaction. You don't want then businesses that are heavily reliant on needing cash flow for big capex, or where cash is tied up a lot in working capital. It works really well in B2B service businesses. Think HR, staffing, recruitment, facilities management, but it also works well in industrial businesses, manufacturing, engineering, etc. I would probably start more with what's your background, your expertise, what sectors have you got a passion about, you're interested in, that you see an opportunity to roll up in. It's far easier to go and have these conversations with banks and sellers if you've worked in that industry or you've got experience, than going into something completely new, or partner with somebody that obviously has that expertise. Parvo's great webinar, Paul, really impressive, full of knowledge, but is there a chance for the replay, please, as I'm not sure of my internet connection, but missed a few minutes on and off? Yes, so this is all recorded. Anybody that's attended, you'll get a recording back from me within the next 48 hours, so you can watch this back at your Leisure. Dave Mason, what terms do you take on joint ventures? So yeah, if you're interested to sort of explore joint ventures, do reach out to me after this call and we can chat through the various different options. But essentially that tends to be on a sort of 50-50 basis. So yeah, if you're interested to have a conversation about that, do reach out. Philippe, how come you spend so much time and dedication and give so much information and value to new or would-be deal makers when some others in the market sell trainings for dollars? Yeah, so essentially, we've done over 100 transactions over the past 15 years. The vast majority of those have been on a joint venture basis. So why do I share this knowledge? Because it hopefully means that I can connect with like-minded deal makers around the world. And ultimately, if we've got people around the world with particular sector specialisms or deal flow that understand the process and want to work with us, it just creates the extra bandwidth. So really, it's about trying to build relationships with other deal makers for us to, better to own 50% of something large than 100% of nothing. So yeah, essentially that's why. Dave, and what are you looking for in joint venture partners? Yeah, so excuse me. I suppose when you get into business with other people, it's a bit like a marriage, and sometimes marriages end in divorce. So it's really important that we're working with people that are like-minded, that are going to add value, going to take action, going to be persistent, and going to be very tenacious. If this was easy, everybody would be doing it. There's a lot of people that approach us for joint ventures that we don't work with because we don't feel that they tick all of those boxes. So somebody that's going to take action probably have this as their main vocation. So yeah, you can do other stuff and have a day job, but you want to be spending probably more of your working week on this, working with us, than anything else that you may have going on. It is a tough sales process. You've got to convince business owners to sell, their business to you. So you really want to, be strong at building relationships, be good at negotiations. You don't need to be an accountant, but have the financial acumen is quite important. But yeah, if you're interested to sort of explore joint ventures with us, reach out. We can hop on a call and chat about it. If there's any other questions, feel free to drop them in the box. Otherwise, if this looks like it's the last ones, another question from Philippe: what are the opportunities to cooperate? I guess I've probably answered that in the previous one in terms of joint ventures. So hopefully that's what you were asking. But yeah, if you're interested in exploring joint ventures, then reach out and we can have a chat. So that brings us to the end of the webinar today. Thank you everybody for attending. Sorry, there's one more question here from Thomas. What would typical structure with board advisors look like? Can you de-risk the potential advisory fees if the deal doesn't go through by offering shares of the SPV to the advisors? And if so, how the structure would look? Yeah, so typically I'd build that sort of dream team, probably start with the finance expert and the chair. I'd probably be looking at between 5 and 10% for them. With advisors, they don't typically like to end up with shares. I'm not saying that it isn't possible or a structure that we've explored before, but it creates a bit of a conflict of interest, particularly if these aren't, self-employed lawyers or accountants, and they maybe work for a professional firm and have got professional indemnity insurance and all those sorts of things. So they might be more willing to work with you on a contingent fixed fee basis. But they're probably not going to be incentivized by having shares in the structure. But that's not to say that a retired Big Four accountant or top 10 international corporate lawyer who's looking for something to do in their retirement may not be interested in that type of structure. Okay, so yeah, that brings us to the end of the webinar today. So thank you everybody for attending. Hope you found it really useful. If you're interested to learn more about deal making, as I say, go to my website, paulseabridge.online, and take our free training to expand your knowledge further on leverage buyouts and how they work and how you actually find and source and put together these types of transactions. And if anybody needs any professional help with actually arranging funding, go to finance4.business, and they could certainly be open to helping you. So yeah, thanks for your time. All the best.